everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And we're going to be looking a little bit outside of the U.S. today, only to get back into the U.S. by the punchline. Obviously, we've had a very big week in markets for volatility, catalyzed by the story that I've argued strenuously supersedes everything else under the sun, and that, of course, is where are Fed rate hikes going, because this is, needless to say, the quintessential conversation about cost of money. Before you get into, I want to buy this asset or that asset, or I want to invest in this sector or that sector, or even at a household level, I want to buy a new car / washing machine / microwave, or I don't. All of that really comes down to the cost of money. Can you afford it, and can the borrowing be justified? And so, in my mind, the Fed story has been the overlay to all things. What we're going to look at today, on a day when things have kind of settled a bit, is a bit of a second order indicator in this narrative, but one that isn't to be taken lightly, I think. Needless to say, the reopening in China, the world's second largest economy, has been a major point of conversation. And we have coming up here today a critical indicator of how that's going. We're going to have inflation data out of China. And this is actually very, very important, not only for the overall market story and for overall market mood, but critically important for the Fed story as well, and for what that's going to do for interest rates and for how that might impact stocks and the dollar and gold and the whole range of assets, crypto, really everything under the sun, because, again, that cost of money consideration is something that absolutely permeates everything. Before you make a decision on where to spend, invest, etc., you first have to make the decision that you want to spend the money and not have cash. And by the way, that means credit, or it means money that's already on hand. Before you decide that you're going to put anything at risk, understanding what the cost of doing that has to come first. And this data out of China is a critical input in that conversation. So let's have a look at why. The first thing that we need to keep in mind here is we are looking at inflation that is not particularly outsized, looking at expectations, certainly relative to the world. In the U.S., we're still looking at inflation that's well north of the 2% target, in the 5 or 6 range, depending on whether you look at CPI or PCE. Certainly, the numbers in Europe are absolutely eye-watering. Sub 10 now, but still incredibly high. In China, with all of the lockdowns that we've seen that have just been suspended in December, inflation is still looking fairly weak. The target there is about 3%. We're expecting to come in from 2.1 to 1.9 for these numbers that we're expecting here tonight. So not a tremendous amount of inflation on the menu, which is interesting because, of course, what we see from China's economy in the past several months is that reopening is really starting to gain momentum. So take a look at, these are official Chinese PMI numbers, and we'll look at the private sector estimates in just a second. I know that there's some concerns, as ever, about the veracity of official Chinese stats. I generally don't have that kind of concern. I don't think it particularly matters if the numbers are shaded or not, because either we're getting a policy signal because the data accurately reflects the economy, and it's the economy that's sending us that policy signal, or it's officials signaling what the policy is going to be by shading the data. But either way, you get a policy signal. And that's really the important thing. That aside, though, here's the official numbers. You can see they are well over 50 across services, across manufacturing, and the composite of the two. In the logic of PMIs, just to quickly review, above 50 is growth, below 50 is contraction in the economic activity for the relevant sector. So that we are seeing these numbers above 50 means that that there is growth. The further you go above 50, the faster the growth is. And the lower you go under 50, the faster the contraction is. And so here, it's a dual thing that we're seeing. We're seeing growth, and we're seeing it accelerate, and at a very brisk speed. So we're looking at the highest levels of economic activity expansion in China in quite a few years here at this point, which of course makes sense. We're playing catch up. We're accelerating into a economy that's reopening after being forcibly locked down. So this is not dissimilar from, for example, what we saw in the U.S., where for a few months there, we were getting PMI numbers in the upper 60s and 70s, just because there was such a ramp up in the speed with reopening to catch up to where the economy was. And so that's seemingly what we're seeing is the economy in China after something of a sluggish January, in February and going into March, seems to be heating up. Here are the private sector estimates for the same numbers. You can see they're not quite as dramatic. These are from Caixin and S&P Global. This is the body that is responsible for most PMI releases in most of the world. The U.S. has its separate version from the Institute of Supply Management. Canada has that as well. They have their Ivy PMIs as well that are separate from the S&P Global ones. But the S&P Global, formerly Market Economics, which is something that S&P Global acquired recently, that's really the gold standard for this kind of data. And so that's what we're seeing on those numbers. And again, well over 50 and accelerating higher. So a bit of a disconnect, perhaps, because you would think that with growth accelerating, you would get more of a pickup in inflation. But it hasn't really done that. And so it bears looking at why it is that we haven't seen it. It might be a lag. It might simply not be there yet. Or it might be something else. And of course, depending on what it is, there are significant implications for the economy and for the world and for the Fed. So let's take a look at the makeup of Chinese inflation here. Now, I should point out, nobody actually knows this with perfect clarity because the components of Chinese CPI are kind of smoke and mirrors clouded. It's very different from, for example, the US or Australia or Canada or any of the sort of major G10 economies, which actually publish the basket. They publish what's in CPI. They publish the weights of each sector. This is a study done by Bloomberg Economics that basically estimates it. And it's a fairly good estimate. What you're looking at here, really the two big components, the ones that really jump out, are the 20% component for food and the 23% component for housing. So between that, we're looking at just under 50% of the entire inflation story in China. And so it becomes reasonably straightforward to have a look and say, okay, with this reopening, where is it we could look to see what is sluggish and what isn't, where inflation is and where it isn't, and why it hasn't come up. So keep this in mind: food, housing. Here's what we see on the food side. So the yellow bars there are overall CPI, and you can see the green one at the end is the expected number for what we're going to see. Marked on the bottom there is December of last year. That's where you get the reopening from COVID. And you can see that inflation excluding food is running quite a bit lower and has been running quite a bit lower than elsewhere. So it's really food where inflation seems to be picking up most. And you can see, of course, that it's particularly getting buoyant in the months after and during the reopening. So December, January. That's where inflation seems to be picking up, and it's food inflation that seems to really be driving it, because inflation excluding food, really still very anemic and still down to where it was when things started to climb down in the earlier parts of last year, largely around those lockdowns. So it would seem that food is really the big story. Now, there's a bit of a seasonality here, because we did just have the Chinese New Year holiday, and that's give or take a month of festivities, with lots of people traveling back and forth around the country, internationally, going back to see relatives in China, and lots of food, lots of leisure, lots of those kinds of spending categories getting a boost. So it could be that as we go into the February number, some of that comes off a bit. It could be some of that that pull from the food side eases. It could likewise be that as the reopening commences, more things open, more things become clearer, and some of the restrictions that China imposed on travel, on the kinds of things that would get food supplies to be smoother, that's going to ease a bit. And so perhaps that food component might come in. And maybe that accounts somewhat for the pull from 2.1 to 1.9. The larger question, of course, is what is then the parallel impact of reopening? One wouldn't think that reopening would have a tremendously positive effect on food prices, because people need to eat. Whether there are lockdowns or not lockdowns, people do need sustenance. And so one wouldn't think that the reopening itself should have such a tremendous impact on food. One would expect it would have some impact. But the bulk of this might end up elsewhere. And so that sort of takes us into a conversation about housing and the cost of housing, because that's the other big component here. That's 23% of CPI. And here the story is quite interesting. So first, in the orange is a 70-city average house price for China, and that's the year-on-year rate. And you can see here that we have had slowing Chinese house price growth. The trend has been decelerating really since the second half of 2018. And you can see that likewise, most recently, so late last year going into this year, it's actually turned negative. So house prices are actively falling, and an active downdraft on inflation, down 2.3% year on year at the last reading. That's quite a disinflationary force, considering housing is 23% of overall CPI. But what you also get with the reopening is a real jump. You can see it here in that dark line there, which is a PMI-like index for housing prices in China. Center for that, again, is 50. So above 50 is showing you that of the cities that are surveyed, more are reporting price gains than price falls. Under 50 would be more are reporting price falls than price gains. The further you go up, the greater share are reporting gains. The further you go down, the greater the share that are reporting losses. And so you can see, for example, back in 2014, at one point you got to zero. And so essentially every city was reporting falling house prices. And what you see recently is with the reopening, there's been a pop. So 52% of the 70 cities that are being polled here are reporting that prices there are going higher, which is an interesting stat here and might imply perhaps some degree of percolation. But if we look at the history here, it does appear as though you have a situation where there's a lot of moving around the orange line for the diffusion index, but ultimately it does seem to track in the same direction. It should also be, I think, pointed out here that there appears to be a bit of a lag. So the diffusion index seems to run a bit ahead of the orange line. It seems to, for example, in 2014, you can see the bottom gets pointedly set in the dark line before the orange one. Then in 2016 and again in 2018, the peaks occur in the darker line faster than they do in the orange one. And so there is perhaps some sense that maybe that negative 2.3% year-on-year rate, maybe that's lagged. Maybe that's not telling us the reality, at least as it is now standing. And maybe what we're going to get is a pickup in the cost of housing. And maybe that's going to give us a CPI number that's a little hotter. That could be. Nevertheless, if you look at what's going on there in 2019, if you look at what's going on in 2020, before you really get into the meat of COVID, you do see that there's a lot of the dark line moving around up and down, but it doesn't really change the trend in what the orange one is showing you. So it'll be interesting to see the interplay. And this is why this is key. This is why this is so important for what the Fed is looking at. So all in all, you can see Chinese economic data has tended to surprise higher, really since the reopening in December. You can see that sharp rise in the red line there on the City Economic Surprise Index, seemingly suggesting that the economy is heating up, seemingly suggesting that even if the food component of this were to ease back, overall economic activity should be bidding up inflation higher, should be signaling that perhaps things are going to get a little bit more active. If that's the case, inflation might be on the way up. At the moment, though, that is not what we are seeing. If the number that we see tomorrow surprises on the upside, and those influences do come in. So if the orange line here does in fact look lagged, if the pickup in the darker one is in fact telling of some kind of a heating up of economic activity in line with what we've seen in the PMIs, then there could be some pressure on inflation. If that's the case, maybe we get some action from the central bank, because for the moment, monetary policy expectations in China haven't really shifted at all since the reopening at the beginning of December. So there's not really a hawkish narrative out there saying, we have this robust pickup in growth. It's not showing up in inflation, so there's no real reason to put the brakes on it. If inflation does come up, that might be more of a logic. Here is why that is relevant for what we are talking about with the Fed, with stocks in the US and globally, and why this is relevant for the US dollar, why the very narrative driving markets in virtually every corner of the financial system is going to be influenced by this. China is the world's largest importer of pretty much all commodities, with very, very few exceptions. What you see in the disinflation that we've seen in the US since the peaks from about mid last year is that they've been accompanied by a pullback in commodity prices. Some of this is, to be sure, the Fed's own doing. The hiking of interest rates as rapidly as the Fed has done, no doubt, has slowed economic activity and no doubt has influenced commodities demand. But lockdowns in China through the same period have been very helpful from this perspective, because they've kept commodities demand under a tight lid. But with reopening in China and with economic activity ostensibly perking up, what you then see is a situation where that sort of headwind for commodity prices perhaps goes away. And that would be something that would bid inflation back up. So if we're seeing out of China tonight an upside surprise on this CPI number, what it might mean is that economic activity is heating up enough to start to bid up commodities again. And if that's the case, well, then you get into a situation where the Fed's going to have to do even more than has already been realized. And by the way, we are in very aggressive territory now for Fed rate hike odds as relative to maybe a month ago. Even in late January, the expectations seemed to be that we could see a peak in Fed rates somewhere in the 4.75 to 5, maybe 5 to 5.25 range. And that from there, we'll get into rapid rate cuts by the back half of this year and be back under 5 by the time that 2024 rolls in. Now, we are looking to be well over 5% a year from today. There is still a bit of a flirtation with maybe a bit of easing into the first innings of next year, maybe somewhere between December and January, but from a much higher level. And a conversation about rates in the 5.5 to 5.75 range, even 5.75 to 6, for the immediately foreseeable future now look much more sensible and much less fantastical. And so if you get a further sort of bid up in commodity prices and you reverse this dynamic that we've been seeing on the goods side of things, really since the middle of last year, then inflation runs hotter and the Fed has to likely do more. And of course, as we've talked about on this show before, the place you would see that is in the 2-year break even, the 5-year break even. I like the 2-year in the US because it's really short term enough to be within the Fed's window. And right now, that's still well over 3%, which essentially tells you the Fed is not going to land its target in the next 2 years. And in order to land it, they have to tighten more. So what we're looking at then is a situation where if the Chinese number is hot, maybe rate hike odds go up in the US. Maybe that's still further weakness for stocks, weakness for gold, weakness for silver, weakness for crypto, strength for the US dollar, and higher yields. Whereas if the number comes in soggy and we're not seeing inflation really catch what's going on with the bubbling up of economic activity in China, at least so far, well, then you still get a relatively dovish monetary policy outcome in China. That, of course, allows that bubbling up to continue. Whether that is inflationary to the extent that it could be were the Fed not aggressively hiking interest rates and raising borrowing costs everywhere all at the same time because of the ubiquity of the US dollar, we might be talking about runaway inflation in China. But that does not seem to be what is going on here. It doesn't seem to be the kind of environment where that's the case. Largely, it would seem, because the Fed is doing that. We've talked before about the US dollar being so quintessentially the global medium of exchange that 80+% of global monetary transactions are settled in dollars. And so when the Fed raises the cost of borrowing dollars, what it's doing is raising the cost of borrowing everywhere, full stop. And so maybe China can get away with inflation being relatively anchored as growth bubbles up because the Fed is doing some of the heavy lifting. But China's financial system is also significantly insulated and closed off, much more so than other open G10 economies where capital can flow back and forth. So this presents a bit of an issue. If the number is soft, on the one hand, it lets China's economy continue to grow because the central bank is not going to push back. But on the other hand, that pickup in growth likewise creates more of a risk that the economy will start to heat up even quicker, and the pull on commodities will be even greater. And so the beckoning for the Fed will be even more significant. Now, of course, that would be a longer term consideration, and we wouldn't see it immediately, but maybe in the coming weeks. And so how the markets react to a higher number versus a lower number will be very, very important. But the knock-on effects to U.S. policy and the Fed seem to me unmistakable. And so it'll be really interesting to see how this develops and to what extent this contributes to the consternation that we've seen in markets, certainly over the course of yesterday and for much, really, of the past year. End of 2022 and early this year notwithstanding. And that is Macro Money for today. I am Ilya Spivak, once again, head of Global Macro here at tastylive. You can track this show 4 days a week, Monday through Thursday, coming immediately on the heels of Overtime with our good friend Chris Vecchio, head of futures at Forex here at tastylive. I'm also on Sundays at 2:55 Pacific, 4:55 Central, 5:55 Eastern Time with Tom and Tony for First Call. And outside of those shows, you can always follow me on Twitter for the various things I'm watching at Ilya Spivak. Thank you very much for joining, everybody. See you tomorrow. Take care.